I think you can take a snapshot in time, maybe a 1 or 2 year period, looking at some standard moving average levels, and see if the stock actually reflects that it relies on those. You know, if you find
Welcome back, traders and investors. We have Joshua Belanger on the line, and he is the founder of OptionSizzle.com. Joshua,
That's me.
You're not related to Mark Belanger, are you?
No, I'm not.
Do you know who he was?
Yes, it has come across a few times. I'm not too specific with him, but the question has been asked.
Shortstop for the Orioles in the 70s, but good one. You don't sound that old. So tell us about your education and your market background.
Well, I've been doing this for, even though I sound so young, I've been doing this for a decade. I started when I was 19 at the Chicago Mercantile Exchange as a runner. And from there, I worked at a few firms in Chicago. My ultimate goal before I got into the Chicago Mercantile Exchange was to be a stockbroker because I got caught up watching the cool movies like Wall Street and Boiler Room. So I thought my ticket to freedom and wealth was to be a stockbroker. So when I eventually got there, I realized it wasn't as glamorous as it was on the movie. I was making 600 calls a day, and it wasn't that fun. I realized that becoming a salesperson wasn't really what I liked. I learned a little bit on the floor when I was a runner, and I went to an options desk, and then I got to become a broker. But I wasn't too happy when I was having to call 600 people and open accounts. And
right.
One of the things I was told, I would ask things about the market. I'd say, hey, go to my peers and, what do you think about the market today? And I was just told, kid, just get back on the phone.
So the trenches of the Wall Street you're referring to as your time on the broker, or are you talking about that your time on the floor? So you were at the Merc, and what was that? You said that was 10 right out of school, 10 years ago. What?
When I was 19, I worked at the Chicago Mercantile Exchange for about a year, less than a year, and shortly there I went to an option desk right next to the Sears Tower called AOS Options. That's where I was first given the opportunities to start studying for my Series 7. That's what I ultimately wanted to obtain, because before that, I was delivering pizzas. And an Edwards Jones guy, he was right next to our pizza place. I went in there and I had asked him a few questions about the market and how to become a stockbroker. And being 19 years old, he kind of looked at me and he's like, well, you have a book of business and you have a Series 7. And he knew that I didn't have that, but he just wanted to make sure that that I knew that I needed to obtain those. And he used to work on the floor. He told me the best opportunity for you would be to try to get on the floor of the Chicago Mercantile Exchange. But he doesn't know anybody that I could contact. So I cold called. I finally got my foot in the door. And that's kind of where my journey started. So after the Merc and going and working for an options desk, I was still making peanuts, and I couldn't continue to make that sacrifice of making nothing. So they told me at the options desk that once I get my Series 7, that they're only going to continue to pay me like less than $30,000, and I couldn't continue to take an hour train ride in from the suburbs of Chicago back and forth. So I finally got a job at a firm, becoming a junior stockbroker. That's where I learned a lot of what I know. I did some private equity. I did some different things as well. I worked on the trade desk there when I went back to work for that company. So those that work in the industry kind of bounce from place to place. So that's why I have quite a different amount of places that I've bounced to. But then in 2008, that's when I started Option Sizzle. And then a year before then, I was managing money on my own.
Okay, let's get into your trading here. And what is your typical time frame for your trades?
At this point, my time frame is usually within within a couple weeks to, I would say the sweet spot for me is about 2 weeks to 6 weeks. That's the time frame I look to do. When I was more active in front of the screen, I was more actively day trading. But from my experience, it overwhelmed me. I didn't see it as valuable, and you become too glued to the computer screen. So I wanted to back away from it. And what I've kind of realized with myself and looking at different P&L statistics is that that's where the best opportunities are for me.
Okay, so you started to learn about options. So what kind of indicators do you use for your trades?
When I first started this, I started with the Series 7, and I learned that about options. When I first was a broker and I had the opportunity, that's when I learned my Series 7. I got that when I was 21. That's when I learned about options. My uniqueness on the phone was to use some of the order flow that I used when I learned on the floor of the Mercantile Exchange, watching locals pick off some of the bigger orders, and that was their edge. So when I started to get into this, I didn't know anything about options except for what I learned on the Series 7, which I thought was going to help me become a good trader. So my first trade, I lost $2,000 on an earnings on options because I was so interested in options. And from there, that's kind of what really took me to the next step of, hey, there's more to learn about this. So I've studied a lot about trading and so forth. And in the beginning, I used different indicators. And, at this point with options, I think the most successful indicator that can be used is obviously learning about implied volatility and being a buyer and seller of options. Now, my go-to is my way of finding unusual option activity, and I think that's the most interesting and the most predictive because that shows where real money's going.
Let's talk about that. How do you do that? How do you find out that are you watching the volumes and all the different options and the stocks? How do you do that?
So the cool term is that it's proprietary, but there's nothing proprietary on Wall Street. I've used the service. When I first started Option Sizzle, I learned about this kind of order flow on the trade desk of where I worked at before the 2008 financial crisis, and it was something that I was learning and becoming familiar with. And really, you compare volume to you compare a certain amount of volume to the current volume. So one of the things I look at, or it's already programmed, is the last 22 days, trading days.
22. How'd you come up with 22?
It just gives you you could do 23, you could do 25. You want to get a good sample of data. You don't want to have too much and you don't want to have too little. And that's kind of the sweet spot, is that you can have too much. That happens with a lot of indicators. You can have too many indicators, or you can have not enough indicators. So you have too much overlap. And the reason with 22, it gives you about nearly a month of trading data. And that's a good sample size to show you if there's something that's unusual. So you take that amount, you take that average, and let's say the average is 10,000 contracts for the last 22 days. Well, if it trades 30,000 contracts, well, that's 2 times. That's something that's interesting that perks my ears up.
So are you apt to go the way of, like, if there's big volume in the calls, let's say in a particular stock, do you pay attention to look at it from the call, from that side, following the big money, or do you like to fade it?
That's the interesting thing, and that's the toughest part about this. It's an indicator, just like every other indicator out there. To me, it shows where money's going real time. And with options, there's transparency. So if there's options that are being bought, that are being bought, that is showing that there is a bias to the upside. Now, there's things that could be happening where they could be using it to hedge a position, and that takes a little bit of experience and kind of teaching as well. But when that transparency is there and they're buying these calls, that provides that uniqueness of, hey, let's take a look at this a little bit more and what could be happening here. And that's where I kind of dive in and look at it a little bit more. So to filter out a lot of the noise, that's kind of the parameters that you want to start looking at. Then you want to go in and you want to say, okay, how many have traded on the offer? What's going on here? Is it because of some kind of headline? You guys were talking about headlines earlier. Is there some kind of headline? If there is, that's when I probably will look to fade it, because it just shows that some kind of chatter, some kind of some of those services that are pushing some chatter around could be kicking this around, and it's part of the action. So that could be a reason to fade it. Or a lot of times creating an option structure, and that's kind of what I like to do a lot. Is I don't like to exactly follow them with the same trade. What I will do is I will look at implied volatility. I will look at some different things. Maybe the implied volatility is high. I'll sell a put instead than playing a call.
Okay. So do you prefer spreads or outright calls and puts?
I prefer spreads. I prefer structured positions because they provide better opportunities of success. Yes, you limit your profit potential, but if you ever, I've done this a long time. I've traded real money and other people's money in my own. There's no such thing as unlimited profit potential. It's I refer to it as kind of a drug, and with options, you really have to take into notice that the time decay is there. You have the implied volatility levels that always are changing, that can influence your call directionally, and a lot of times it's just better because you don't know exactly the reason why they put that trade on, and ultimately they could be wrong as well. You're kind of just following them and taking the little bit of the easy way out, hoping that they're right, but they can have a time frame or risking that whole lot that they put on, while you have a different type of approach. So they could be risking $50,000 and you go in and you risk $1,000, but you have a stop, let's say 50% of that. Well, they're willing to risk that whole premium to let it play out because that's what they manage the risk. You, on the other hand, could be stopped out and only can see it move higher. So that's where the little bit of the disconnect and the troublesome for a lot of individuals that do try to follow that is the tough part.
What about the charts? Do you pay much attention to technical analysis?
I'm very familiar with it, and yes, I still look at charts. Visually, it's hard for me. Some people that I know, that very successful traders, can not even look at a price chart. And I've tried myself, but I like to look at it, and I like to see what the price action is. I do believe that there's a story to be told there. I don't know how accurate it is, but for me, visually, I just like to see it and look at them.
So if you do see some unusual option activity in something, and you're not necessarily looking at the charts, I mean, do you dig into the fundamentals at all of companies?
No, I really don't get caught in it. I mean, 2 to 6 weeks, you're not really caring about fundamentals. You look at Apple, you have earnings. That's just an opportunity with options, and that's really my forte is options. I think when you go into fundamentals, you start looking at stocks and you get caught up in that. That's for not individuals. Those are for institutions. Those are for pensions. Those are for people that have a lot of money, because that's their business model. That's how they get paid. They get paid to take your money and put it in, and that's what they have to do. For individual traders or investors like you and I, we don't have that amount of money to be able to have tied up in stocks and to get caught up in stories. Sometimes it can take a long time. I mean, you look at the market. I know you guys were talking earlier about the IWM, but for the longest time, people have been bearish on this market for the last, I probably would say, pretty actively since early January, and even myself. Now, you could be right on the fact that the market's eventually going to go lower, because those last week, those 2014 gains were completely gone, and now they've come back a little bit. But turns to the downside can happen pretty quickly, and that's what happens when you have stock and you have it tied up in a fundamental story. Is that when it goes against you and it overall kind of goes against you, where are you going to raise the capital to be able to hold yourself out? Because usually you have your capital, all of it tied up, and with options, it's the other way around. You have less is more. That's something I talk about a lot. But
Okay. All right. What about some advice for new traders of options?
anything specifically, or
Yeah, I mean, just someone that, let's say they've traded stocks, they really haven't, buy and hold, ties up a lot of equity. If they're looking to get into options, is there a favorite book that you read that got you interested? Is there, I mean, obviously your site gets some good insights into it. What just general advice do you have for new traders?
well, the value that I thought I provided to the market is when we come into options, it's very outdated, and I've read books from Larry McMillan. I mean, I'm looking at it right now. Um, Jeff Ogden, Sheldon Nadenberg. That's a book that's when you asked the previous question to that answer. Volatility is very important. Implied volatility to options is very important. It's the key to success. Not only if you're a buyer of options and you say, Josh, I don't care about selling, but it's also the key ingredient to be successful selling of options. Because if you sell an option that has low implied volatility, you're going to get annihilated. Because if you did that before we saw that move lower, well, implied volatility was low. It expanded, and it likely went through any kind of short strike that you had. If you had an iron condor, even though if it's defined, or just a strangle, you likely got pretty beat up. And the reason why is because the implied volatility was relatively low. Now, when it spiked up, when the VIX was at 31, those are the opportunities that you look to put on and sell options, because that's where the implied volatility, that's where you're getting paid to put on that risk. And a lot of people kind of get into the game with buying of options, and they get hurt by that same move in implied volatility, and then they want to go into selling of options, and they still have that same struggle because they sell the same underlying when implied volatility is changing in that underlying, and they go to the same well over and over again. And what happens is like something happens, and that is shown by them getting a really large drawdown by selling an option. And a lot of people refer to it as getting run over by a steamroller.
Okay. All right. We've had Joshua Belanger on the line. He's the founder of OptionsSizzle.com. Been trading options for better part of 10 years. Joshua, thanks for coming on. Some good words of advice there for people that want to be active in options, and we hope to have you on again.
Absolutely. I appreciate it.
Okay.
Enjoy the morning.
Yep. Have a good day.